Active trading may be difficult and time-consuming, with poor outcomes. There are, however, alternative solutions available. You, like many other investors, may be seeking for a less demanding and time-consuming investment strategy. Or just a more passive investment strategy. But what if you want to invest in the markets but have no idea where to begin? More precisely, what is the best approach to establish a long-term position? In this video, we'll go through the DCA, or dollar cost averaging, investing strategy, which is a simple method to mitigate some of the risks of joining a position. What exactly is dollar cost averaging? Dollar cost averaging is an investment strategy that seeks to mitigate the effect of volatility on asset purchases. It entails purchasing the item in equal cash amounts at regular times. The theory is that by joining a market-like way, the investment may be less volatile than if it were made in a flat amount, i.e., a single payment. How so? Buying at regular intervals, on the other hand, may level out the average price. In the long run, this strategy mitigates the negative effect that a disastrous entrance may have on your investment. Let's look at how DCA works and why you would want to use it. Why is dollar cost averaging used? The major advantage of dollar cost averaging is that it decreases the risk of placing a wager at an inopportune moment. Market timing is one of the most difficult aspects of trading or investing. Even if the direction of a trade idea is accurate, the timing may be improper, rendering the whole deal invalid. Dollar cost averaging helps to mitigate this risk. If you break your investment into smaller pieces, you will most likely get greater outcomes than if you invested the same amount in one huge chunk. Making an ill-advised purchase is surprisingly simple, and it may lead to less than ideal consequences. Furthermore, you can remove some biases from your decision-making process. When you commit to dollar cost averaging, the strategy will make all of your choices for you. Of fact, dollar cost averaging does not totally mitigate risk. The goal is simply to smooth the market entrance so that the risk of improper timing is reduced. Dollar cost averaging will not ensure a profitable investment. Other considerations must be considered as well. As previously said, market timing is incredibly tough. Even the most experienced traders have difficulty reading the market effectively at times. As a result, if you've dollar cost averaged into a position, you should think about your exit strategy. That is a trading strategy for exiting a position. If you've already decided on a goal price, or price range, this might be a reasonably simple process. You, once again, split your investment into equal portions and begin selling them when the market approaches the objective. This manner, you may mitigate the risk of not getting out on time. However, this is entirely up to your own trading method. Some individuals use a buy and hold strategy, in which the aim is to never sell since the bought assets are projected to rise over time. Take a peek at the Dow Jones Industrial Average's performance throughout the past century below. While there have been brief times of recession, the Dow has been on an upward trend. The goal of a buy and hold strategy is to join the market and remain in the position long enough that timing is irrelevant. However, bear in mind that this kind of strategy is often targeted toward the stock market and may not be applicable to cryptocurrency markets. Keep in mind that the Dow's performance is linked to the real-world economy. Other asset types will perform very differently. Example of dollar cost averaging. Let's look at an example of this strategy. Assume we have a set dollar amount of $10,000 and believe it is a safe bet to invest in Bitcoin. We believe that the price will likely remain in the present range, and that it is a good time to acquire and develop a position utilizing a DCA strategy. We might split the $10,000 into $100 increments. We're going to purchase $100 worth of Bitcoin every day, regardless of the price. This manner, we'll be able to stretch out our admission across around 3 months. Now, let's use a new game plan to show the adaptability of dollar cost averaging. Assume Bitcoin has recently entered a bear market and that a sustained bull trend is unlikely for at least another 2 years. However, we anticipate a bull trend in the future and would want to plan ahead of time. Should we use the same strategy? Most likely not. This investment portfolio has a much longer time horizon. We'd have to assume that this $10,000 would be used for this strategy over the next 5 years. So, which option should we pursue? We might split the investment into $100 increments once again. This time, though, we're going to acquire $100 worth of Bitcoin every week. Because there are around 52 weeks in a year, the complete strategy will be implemented in little less than 2 years. This approach, we may establish a long-term position as the downtrend continues. We're not going to miss the rise, and we've also mitigated some of the risks of purchasing during a downtrend. But bear in mind that this strategy is dangerous since we'd be purchasing during a downtrend. Some investors may choose to wait until the conclusion of the downtrend is proven before joining. If they wait it out, the average cost, or share price, will most likely be greater, but most of the negative risk will be mitigated. Calculator for dollar cost averaging. On DCABTC.com, you may discover a useful Bitcoin dollar cost averaging calculator. You may enter the amount, time range, and intervals to see how alternative methods might have done over time. You'll discover that in the case of Bitcoin, which has been on a long-term rise, the strategy has been consistently performing extremely effectively. Arguments against dollar cost averaging. While dollar cost averaging may be a profitable strategy, it is not without its detractors. It surely works best during market ups and downs. This makes sense given that the strategy is intended to mitigate the consequences of excessive volatility on a position. Some argue that it will cause investors to miss out on rewards when the market is doing well. How so? If the market is in a protracted bull market, it may be assumed that those that invest sooner would benefit more. Dollar cost averaging may decrease profits in an upswing in this manner. Lump sum investing may beat dollar cost averaging in this instance. Even yet, most investors do not have a substantial sum of money to invest all at once. They may, however, be able to invest little sums over time. Dollar cost averaging may still be an appropriate strategy in this scenario. Final thoughts. A popular strategy for initiating a position while limiting the consequences of volatility on the investment is dollar cost averaging. It entails breaking down the investment into smaller portions and purchasing at regular periods. The following are the primary advantages of using this strategy. Timing the market is tough, but individuals who do not want to actively follow the markets may nevertheless invest in this manner. However, some critics argue that dollar cost averaging might cause certain investors to miss out on returns during bull markets. However, missing out on certain returns isn't the end of the world. Dollar cost averaging may still be a practical investment strategy for many people. Thank you for watching.